Welcome to our channel. Today we're about to plunge into an in-depth comparison of money market accounts, MMAs, and money market funds, MMFs. These are chosen by many for financial management purposes. Fundamentally, MMAs and MMFs are financial tools aimed to manage and grow your cash assets. They are used by individuals, businesses, corporations, and even governments for their flexibility and potential returns. Money market accounts, MMAs, are a type of savings account. They usually require a higher minimum balance than regular savings accounts but offer a higher interest rate in return. This high interest rate makes MMAs an appealing option for individuals seeking a safe, profitable place for their cash. Conversely, money market funds, MMFs, are a type of mutual fund that invests in short-term investments issued by the US government and corporations. They are considered low risk and give investors an easy way to gain exposure to these types of investments without a large capital requirement. MMFs can offer higher returns than traditional savings accounts. Key differences between MMAs and MMFs are in their risk profiles, return potentials, and access to cash. MMAs are insured by the Federal Deposit Insurance Corporation, FDIC, making them virtually risk-free. MMFs, on the other hand, while generally safe, are not FDIC insured and carry some risk. In terms of returns, MMFs can potentially offer higher returns than MMAs, particularly in a rising interest rate environment. However, this potential for higher returns is accompanied by a higher degree of risk. Access to cash is a key factor when deciding between MMAs and MMFs. With an MMA, you have quicker access to your cash, while with an MMF, it may take a bit longer. These are two popular options for managing your cash, but they have some key differences. Let's start with money market accounts, a financial instrument offered by banks and credit unions. Often abbreviated as MMAs, these are a vital part of the financial system. They are similar to savings accounts but offer higher interest rates, making them a magnet for investors wanting a better return on their deposits. MMAs are a type of deposit account where one can place their money and grow it over time. They're occasionally confused with money market funds, but it's crucial to underline that they're different. MMAs are provided by banks, while money market funds are mutual funds investing in short-term, high-quality debt. A key feature of MMAs is that they are insured by the Federal Deposit Insurance Corporation, FDIC. This agency provides insurance to U.S. bank depositors, bringing an extra security layer for MMAs holders. This coverage implies your money is protected up to a set limit, even if the bank fails. MMAs are suitable for those seeking a secure, easily accessible place to keep their money while making a modest return. They offer a certain liquidity level, allowing you to withdraw your funds when needed without penalties. However, MMAs often have limited check-writing capabilities. Although you have some funds access, it's not as immediate or handy as with a checking account. This limitation is a trade-off for the higher interest rates MMAs grant. Moreover, some MMAs might need a minimum account balance to avoid fees. This requirement can dissuade some, particularly those who can't maintain a minimum, and should be considered when deciding to open an MMA. In conclusion, money market accounts are an excellent choice for those who want the safety and assurance of a savings account, the added interest of a CD, and the liquidity of a checking account. They offer a valuable blend of elements that appeal to many people, despite their limited check-writing abilities and possible requirement for a minimum balance to avoid fees. Now let's talk about money market funds, or MMFs, investments offered by brokerage firms and mutual fund companies. Investment products are essentially financial commodities designed to grow money or provide income. These companies act as the middleman between investors and the financial market, contributing to economic growth. MMFs are a particular type of investment product that invests in low-risk, short-term securities. The unique feature of MMFs is the pooling of investors' funds. This pooled approach enables participation in diverse short-term low-risk securities like treasury bills and commercial paper. T-bills are the safest investments, fully backed by the US government. Commercial paper is short-term debt issued by established corporations. Despite lower return rates, these assets' lower risk makes them desirable. Unlike money market accounts, MMFs are not FDIC insured, meaning the value of your investment can fluctuate over time. This is different from a money market account, where deposits are insured up to $250,000. MMFs, however, strive to maintain a stable $1 per share value. MMFs often offer higher yields than MMAs, increasing their attractiveness to investors seeking slightly higher returns. These returns are the results of their risk-taking investments. Despite the potential for higher yields, MMFs are favored by those who prioritize safety. MMF's balance of risk and return has made them a significant part of the financial landscape. Let's compare these options based on key factors. Beginning with risk, money market accounts or MMAs boast lower risk due to the safety net of FDIC insurance. This government-backed insurance safeguards the depositors of a bank for amounts up to $250,000 per depositor per bank, making MMAs safer for risk-averse investors. In contrast, money market funds or MMFs, a type of mutual fund, carry more risk as they lack insurance. Although MMFs are generally low risk, the absence of insurance implies a potential risk of loss to the investor. Moving on liquidity, MMAs provide easy access to funds with a cap of 6 withdrawals per month, making them suitable for those seeking flexibility to access their savings when required. Conversely, MMFs may have redemption restrictions or fees limiting investors' swift access to their funds. Some funds may impose a fee on redemption and may have a lock-in period barring withdrawals. Regarding yields, MMFs usually offer higher yields than MMAs. However, these higher yields are not assured. Market volatility and interest rate changes can affect MMF's yield, resulting in a yield lower than expected or even a loss. Lastly, we address convenience. MMAs are convenient for everyday banking, offering a spot to store your money while earning a small interest. They are user-friendly, making them attractive for people desiring a simple savings option. On the other hand, MMFs suit investors seeking short-term investment options. They potentially offer higher returns than MMAs, making them appealing for those ready to accept some risk for higher returns. So to sum up, MMAs are convenient for everyday banking needs, while MMFs suit investors looking for short-term investment options. In conclusion, money market accounts can best be compared to souped-up savings accounts. They prioritize safety, offering a secure and steady way to grow your money. On the flip side, money market funds are riskier, their value fluctuating with the market. But this gives potential for higher returns. The choice between these two should be based on your financial goals and risk tolerance. It's a decision between safety with MMAs or potential high returns with MMFs. Understanding these will aid in making an informed decision. We're here to make these financial terms easier for you. Our videos provide valuable insights to help navigate your financial journey. Remember, knowledge is power when choosing the right financial pathway. Hit the like button, share this video, and subscribe channel for more insights. We're all in this journey together. Let's help each other. Lastly, click the subscribe button for Prosperity Pulse for more financial tips. Until next.